Now, when we talk about behavior in the context of business, let us touch upon behavioral finance and look at psychology of money, how people think about money, what do they understand by money. What we know from research is that it is very hard to think about money in any real degree of clarity. People have been using various types of barter systems and symbolic systems to exchange goods and services. But it is still very hard to think about money in any real degree of clarity. Why is that the case? Actually, people have challenge thinking about or planning long-term savings and investing. Not just long-term savings, people also have difficulty managing short-term spending. You might have come across a variety of situations where people have difficulty understanding insurance and financial planning, primarily because of two reasons. Let us say one is a complex language financial products use, and the terms and conditions. So there are certain examples of insurance being missold to consumers because consumers do not understand two things. One, the language and the terms and conditions, and secondly, the time context, which is that they cannot imagine how things will be in 50 years from now. So in those cases, the driver is the market rather than the need of the consumer. In those mis-selling cases of insurance or other financial products, many of us have heard about these, and governments have made certain regulations to avoid such kinds of issues. There are certain necessary disclosures, but they still have a complex language. So people have difficulty understanding money. This is very important to recognize if we want to have consumer protection regulations and to protect and to have a better trust with your consumer. In the context of investing, people actually also have difficulty understanding and navigating volatile markets. How the markets will change is not really predictable based on only certain factors. Now, there are too many financial products in the market as well, something called choice overload. You can't decide which mutual funds or which stocks you want to buy just based on certain kinds of information. Now, that is also subject to what we call investor risk appetite. Now, there is an over and underestimation of risk capabilities. So we do not know that we know that not all investors have the same level of risk appetite. And that is a challenge for both the consumers as well as the service providers. In fact, you might have seen that the trading platforms routinely present us with the past performance report of the stock or the mutual fund or any kind of bond you are thinking of investing into. We know that the past performance is no certainty for the performance in the future, but still that is being used. And that plays a big role in influencing you to buy or to go for an investment or not. Now, what can we do in these situations? We can use behavioral economics or behavioral science to understand certain segments which are rooted in different investor biases. This offers empirically validated solutions. So we can nudge investors. At a time when markets are falling, we can, for instance, many organizations recommend that consumers should stay back and not sell really quickly. So they use a certain kind of behavioral dynamic here to influence consumers to stay.